Hello and welcome to Fidelity Now. I'm Jordan Chevalier. Joining me today to discuss his thoughts on the ongoing trade war and how recent interest rate decisions are shaping current allocation strategy is Fidelity Portfolio Manager David Tulk. David is a member of Fidelity's Global Asset Allocation Group. David, thank you for joining us today. I'm sure this will come as no surprise. Let's start with tariffs and the ongoing trade war. Updates are coming in at a rapid pace. How is this all shaping your current allocation strategy?
Yeah, I think the tariff war is emblematic of a greater source of uncertainty and volatility, not just in the US economy, but in markets more generally. So our asset allocation has evolved because one of the things we've said in the past is you don't want to overreact to the headlines, but at the same time, you don't want to underreact to fundamental shifts that we think are taking place in the global economy. So one of the views that we had previously was an overweight into the US equity market. And that was motivated largely because we thought the US was where the growth was, where earnings were strongest. And despite the fact that the US was expensive, we recognized it was justified in the fund to some extent by the fundamentals. With the tariff war and what the current administration is doing, it's really challenging that notion of US exceptionalism. So as a result, what we've done is we've trimmed significantly our allocation into the United States. So we're no longer overweight the US. What we're looking at instead is allocating to economies elsewhere around the world. So this is primarily taking place in Europe, in Japan, as well as in emerging markets. So part of the motivation there is recognizing relative cheapness, but also seeing some evidence that Europe and other economies are maybe getting their act together to actually provide a positive growth impulse into their economies. And that can be very beneficial from a rotation story, which is what we're trying to do. There's also a second element of the evolution in our views, which really comes down to recognizing what tariffs are. So tariffs truly are a stagflationary shock. And as a result, what we want to have in our portfolios is a little bit additional protection against inflation. So we're holding a little bit more inflation-protected government debt, as well as a little bit more gold in our portfolios, because I think that's appropriate to kind of understand the notion that you need a little bit more defensiveness in appreciation of a higher than normal level of uncertainty.
That's fascinating, David. Thank you for that. Let's move quickly now to interest rates. Last week, the Bank of Canada cut rates by 25 basis points. And in the US, the Fed held rates. What do these recent announcements mean for investors?
I think it's quite clear because it really gets down to what the relative impact of the tariff shock is to the two countries. So the US is a large, generally closed market economy. So tariffs do hurt to some extent, but not nearly as much as they do to a country like Canada, which is a small open market economy that depends far more on international trade. So when you're the central bank in Canada, you recognize that the shock to your economy is primarily going to come through lower economic growth. So as a result, you're cutting in response to that, whereas we saw from the Federal Reserve, they need to try to balance both the inflationary impact with some deterioration in the economy. So as a result, they're basically walking the line of keeping rates unchanged, ready to respond to future developments, whereas the Bank of Canada, I think as long as this tariff risk remains and could potentially intensify, they will be focused primarily on trying to insulate the economy by cutting interest rates further.
And lastly, David, what is your approach to managing volatility?
Yeah, I think the most important approach to take today is really emphasize diversification. So it is a very uncertain environment. There are a whole range of different outcomes that nobody really has any insight into. So the best way you can try to protect your portfolio is to ensure that you have allocations in a balanced fashion across lots of different asset classes, lots of different geographies that will ultimately make your portfolio resilient to a wide range of market outcomes. Because until we get greater clarity on any of these issues, nobody really has much of an idea.
To read the latest market commentary from David and members of the GAA Group, the new commentary is available now on fidelity.ca.